Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Thursday, November 9th, 2023. It is 3:06 p.m. Eastern Time, so we have a little less than an hour to go on the trading day. I'll try to get it out to you before the close. Nothing really new or different from what I've posted. I've fired off a few posts as well as a lot of replies in the comment section today, or at least a few to both, with these, the indexes, Treasury bonds, and then a couple other questions. I just wanted to kind of do another update there. This morning I had a bounce coming off the top of the pullback target zone. And as I said, we still very well may get that, but I think we're going to probably come down more. Remember that I gave you in the video today and on that second post, this is T2 down here. I opened it up to the potential. This was my minimum pullback target zone, and now it's been hit. So, that's a 1.5% drop from the breakdown there. And if you want to book the profits, great. Odds favor a reaction at least, tradable bounce. But how far it goes, that'll be yet to be seen. Remember, if we end up here and we don't bounce and get back up here soon, if we get a little reaction or no reaction, we go to the bottom of the zone, especially if we get down here to T2. This is the 30-year, but remember that's also going to take the 10-year down with it. And then that whole thing I covered earlier, and again, I just, I try not to rehash the old, something I just covered, but this is significant. So, and what I want to just say, and I'll get it out here. I said it before, but I think I can phrase it a little more clearly now. There have been a lot of bullish developments lately, including and not limited to the pullback in interest rates, which was by far the most important one. This abatement, this drop in yields. Again, this is a daily chart, but you can see that drop there. We've also had, from a technical perspective, only looking at the stock market, all my big Magnificent Seven stocks hitting and holding key support levels that were identified well in advance that they would need to break to open the door to much more downside. And as I like to say, support is support until it's broken. So they exploded off those levels, the 200-day moving average, those that tested it, including QQQ and everything else. So there's all that, right? And that may continue to play out, and that certainly keeps the door open for that marginal new high scenario. However, my thoughts. I'm kind of overriding, not fighting it, but just open. I'm completely open to the fact that this may be that kind of return to normal thing. I gave you the analogy, the breakdown of a bear market, how bear markets usually play out, and you get this kind of rally. And I didn't do it recently, but I've done it in previous videos where I've showed you, going back to the last real bear market in 2007, 2008. I have different boards here. You probably can't see it here. I'd have to zoom in. I guess it's worth digressing in this video. I didn't mean to cover it. But you had a point in the bear market early on after the first big bear market rally. This was the high, the end of the last real bull market, in my opinion, 2007, October right there. And then we had a nice, we had a first bear market rally and then a much bigger one right there, comparable to the one we have now. Actually, this was back, the bear market rally in the off the dot-com bubble was very close, in about 55%, I think, versus this one being about 57, 58. I did cover that more recently. Again, that was back here. But and that was also coming off a supersized bull market, a lot like this supersized bull market. So there it is. The bear market rallies, therefore, were a lot bigger. The NASDAQ composite, I think, was 55%. The NASDAQ 100 was about 40-something right there. Yeah, 45. Okay. Where I'm going is, and I've highlighted this a while back, we had just before the bottom fell out, and it's also, we had it also on the daily chart. We had positive divergences in both the stock market and bonds as well. You look at TLT. I think I marked that up today. Was it TLT or IEF? One of the two. If not, I'll draw it out for you. Okay. No, disregard. That wasn't it. I was looking at something else. Sorry, a little bit of a brain fart there. I was kind of, again, doing this video. I don't have any scripted notes or anything I'm following. I usually just jot down some bullet points I want to cover and then kind of ad-lib it. But no, remember, back then in the last bear market, which was right here, this is when the stock market top we had a normal bond market. Remember, it's something I've been talking about for a long, long time. Forever and a day, the old 60-40 rule worked, 60% stocks, 40% bonds, because when the stock market took a dump back from starting in October, but especially when the financial crisis hit in '08, stocks were in free fall mode. We all know what happened then, 55+% drop in both the S&P and the NASDAQ 100, and bonds shot up. That is what we call a flight to safety bid. Bonds shot up for multiple reasons, economic growth expectations sharply dropping, inflation expectation, and a flight to safety bid. And again, the opposite happened in 2002. So I just want to say that, and I do think at some point, as I said, we'll see somewhat of a return to this, or maybe again, it's not a singular event. So the first part of it might be just a decoupling. You don't have to have two different asset classes like stocks and bonds be perfectly positive correlated or negatively correlated. You can have a no correlation or a low correlation. So that's probably how it'll start. And those are the cues we're going to look for. Today, the correlation is very strong. As I said, one of the posts I got out to earlier, I have a little wordplay in there. I used the word expected and said something. So, the expected reversal in Treasury bonds, which we got based on the wedge breakdown, led to the expected pullback in the stock market. Remember, because that high correlation is still very much there. And if you look at this, so what happened today is we started to go down when treasuries did. The stock market didn't get the memo right away. The small caps did, even S&P, but NASDAQ thought it would get cute and try to go the other way earlier today. This is the close of the previous day. And today's open. Here's today's open right here. So you can see this morning, NASDAQ thought it would kind of get cute and go against the grain. But then, again, it got the memo that, hey, treasuries are falling. We can't go up because we have everybody's hyper-focus on rates. And so you have one of at least the biggest drops and certainly the biggest intraday reversal, 1.4% off the highs so far in quite a while. And again, not mere coincidence that coincided with this. So treasuries out of the gate, we're moving lower. And that's where the NASDAQ, and those are trading opportunities. If you felt like this morning, you read the post and saw the pullback. I've been talking about the pullback coming for a few days now. I've highlighted several objecting shorting ops that didn't materialize yet, but that doesn't mean I'm going to give up and just, okay, I can't fight it, I'll just go long. No, it's, the more stretched you get, the more, and again, this didn't happen. We had to have, as I said kind of a week ago, I said, you know what? Kind of looking for, to get back in short and I just can't do that until I can make a case to be short treasuries because of that correlation. Now, okay, where am I going? This is just a pullback. I gave you a pullback target on TLT and CB. We already hit it, and we're right there right now. I suspect we go lower. Of course, reaction first makes sense. This is a perfect support level on ZB, the top of that pullback target zone I gave you, and we hit the target on TLT. If you're trading, it was total down about 2% from the breakdown today to the lows. Okay, but let me talk about this. This is what I wanted to share and kind of put some of my thoughts out a little bit more clear. I think there are three things. If we're gonna override the bullish technicals that we've seen over the last couple of weeks, again, the indexes remaining above the 200-day support, especially those market-leading big tech stocks, the 200 days here, breaking the downtrend line. If we're going to continue even after correction, again, I think, as I said yesterday, I think even the most bullish bull will say right now, well, we're a little bit overbought. I'd like to buy on a pullback and work off the overbought conditions and then game the next leg up. If that's going to happen, I think we're going to need to see rates stay lower, or at least, continue to fall. Absolutely, continue to fall and hit those additional targets I gave you on TLT that have yet to been hit. But if this whole bear market rally thing from here to here, bigger picture, weekly chart, going to the weekly chart, turn off all the lines, assuming if you're going off this being the first leg down in a new bear market, a much larger bear market, this being a bear market rally, and then another leg to come soon. And if you're an Elliott waver, and these are the primary waves, a primary trend, or a 5-wave is a primary directional wave, I think is what they call it. The term might be off. And you have wave 1 down, 2 up, 3 down is always the largest in a primary 5-wave count. And so again, that would kind of fit with where we're at. I think if we get anywhere near, and especially below those recent lows, the bottom will fall out of the market. In fact, I already told you the level I think the bottom will fall out of the market, and that's all those purple lines on the big Magnificent 7 that were recently tested, and including these 200-day moving averages. And remember, the 200 days on QQQ right here, which are 40-week moving averages, come in there. So it's not much. I think if we get down here, that's where I think the impulsive selling starts. I don't think you have to wait till right there. Okay, but let me just state this. I think there are going to be 3 things that will have the potential, or these are 3 of the big things I think that have the potential to make that happen, despite recent very strong price action and strong technicals, including the positive divergences and the successful defenses of the key support levels in 200 days that I mentioned. So number one. And so when we're talking about bonds and putting a bond short out there, will be a kind of a WTF moment for the bond bulls. In other words, those that kind of see what I saw recently. Cancel that. Remember that we have huge bullish divergence. This is a weekly chart of TLT. IEF has it too. Just ginormous positive divergence. And again, I think I know in the stock market we had some big divergence like that back in 2008 after the whole bear market started, but hadn't yet really, the big leg down didn't hit. And so I always say this, divergences, they play a big part of my trading, but they're not the be all end all. And I've seen them fail to materialize. And when they don't, when you have a bullish setup like this, that is textbook looking for many reasons. We have the trend lines, and yet it fails to play out. It usually starts to play out and sucks a lot of folks in. Believe me, I'm in. I'm still long-term accounts. I'm not trading that. I'm actively trading the ZB futures in my trading account, but I'm still very much open to the idea as those higher targets are going to be hit. However, if they don't, and we just come on down through there to take out the lows. In other words, that's going to entail a new multi-year high in Treasury bond yields. And then if the divergences are taken out, that's where things get really ugly. Now that is one scenario. And let's just say right now, because I'm not looking for a huge leg down at this point in bonds. Remember, I'm talking about that handoff or transition back to the uncorrelated or inversely correlated relationship between stocks and bonds. But in the very near term is what I'm getting at. If we have another jog down and we retest the recent highs and yields, which are the recent lows in Treasury bonds, that would put the hard brakes on the stock market rally. Okay, so that's one. Would be a sudden and larger than expected reversal. Okay, so what we had today, let me go back to that. That's just a run-of-the-mill pullback. If you're an active trader, like you see that coming, and you can still be intermediate term bullish TLT, looking for these targets up here, and then nothing goes up forever, so you get this little leg up, trade a little pullback, go hit your next target, pull back, and then work your way up there before reversing back short again. So that's a possibility, but where I'm going, if that fails to materialize and we come down here quick, that would put really bring the stock market down, in my opinion. Anywhere even coming back to these lows, everyone will talk about the whole head fake, whipsaw. So that's one thing to watch for. Again, the odds on that I put somewhat low, but certainly worth mentioning. And again, what I do, day in, day out here is try to point out potential developments in advance, and then how to react or how I'm going to react to those. So that's one, Treasury yields. Number two would be you can put 2 or 3. I don't have any one of them in order ahead of itself, but this would be the economic indicators largely those related to the job market starting to trend up. So today, jobless claims, as I said, was a non-event. We came in right around expectations, although continuing claims was a little hot. And again, it's not ever going to be a single print. It can be one single print that's so bad it's a flashpoint that kind of ignites a big drop, but more so a trend. So I'm watching that. And again, there's various employment reports that come out both from the government and the private sector. So we'll watch that trend. So number one. Number two would be economic data indicators rolling over, and an acceleration, a clear trend starting to emerge that especially the job market's weakening. And then number three is, I've been talking about forever, and I'm not the only one, where is the next shoe to drop? To me and some others, it's not a matter of if another big shoe is going to drop. I'm referring to, with the regional bank failures earlier this year. But again, so those are the things, and this one obviously has a potential to come out of nowhere. If they whoever calls it a black swan anytime in the near future that something breaks, I think they're not using that term properly, because again, so myself and others have forecasted that the banks were just a shot across the bow. Something else is going to break with these high rates, unless we see just a huge abatement. Yields really start to come down, and they're coming down from anything other than a stock market meltdown. Just natural forces bring rates down. That could give a little more life to the economy and into the stock market. But so again, if it happens, I won't call it a black swan because it's expected. Black swan events come out of nowhere. No one sees them coming, and they're not expected. So that would be that. And so those are the things I'm watching. And let me get back to the QQQ charts, and I'll wrap the video up with just some of the Q&A that I answered today in the comments section. So if you recall, the first real target, I gave you a target zone in here. I was on this board. But the first real target is going to be a back test of the trend line, which we pretty much have now. That's the primary downtrend line on QQQ. Remember, the other key index is really the stock market, SPY, and what is it, VTI, that Vanguard total stock market tracking ETF, tracks small, mid, and large caps. That's still well below its trend line, its comparable line. Here, let me go to the daily. That's where I have it drawn. So this is the total stock market. Small, mid, and large caps all in there. And of course, SPY is not the whole stock market. It's only a sliver of the large caps. It doesn't include the mid, small caps, but that also just got rejected today. You see, and I'll tweak that down. And I did that so we can come in here. We have a big red bearish engulfing candle today, big rejection candle there. So that's worth noting too. Okay. So the stock market, it just got rejected today. Let's say that off its primary downtrend line. QQQ, great trading vehicle, but it's not the stock market. It's really a sector ETF. QQQ is just XLF is all it is. XLF is a tech sector ETF. It's not exactly, I'm being a bit facetious. I'm sorry, XLK. I always do that. XLK, tech sector ETF, which is only tech stocks. But when you take a look at, overlay it with QQQ, you can see the white lines. It's an exact mirror. Why? Because of the heavy, 50+% tech weighting in the NASDAQ 100 and the overweighting of the big top components. So that's that. And of course, that looks even better. Look at that. It looks even better than QQQ. So this just goes to show what I and others have said. This all year, the rally off the January lows has been almost exclusively due to the performance of these guys because they're super heavy weighting. Microsoft, Apple, to be the Magnificent Seven. Well, speaking of XLF, since I accidentally typed it in, remember that's just in that big giant symmetrical triangle. This is how I had it drawn on the other board. You have a downtrend line here and an uptrend line there. Symmetrical triangle patterns can go either way. You need to respect whichever way it goes. It's certainly possible to have a false breakout on either side, but any breakout, especially a sustained move away from there, will most likely determine the next major trend. in the financials. And this is a big sector. Of course, you have the regionals as well, sucking wind today. Again, down 2.41%. So what's wrong here? So we've had, today's a pullback in Treasury yields, but we've had one of the sharpest rises or pullbacks in yields in a while. That should have been quite bullish for the regionals, but they're really, relatively, if you're going to say, oh, well, Randy, they're up, 8.8%. No, relatively speaking, the regionals tend to go up and down and on any given day a whole lot more than the market. They're much more volatile, and so that is relative underperformance, especially when you look at the rally and QQQ and everything else. And I gave you some numbers today too on IWM. IWM is also severely lagging, and I have different boards on that. Okay, let me roll into the Q&A, and then I can wrap this video up and maybe possibly get out to you by the close. Let's see here, 30-year wedge breakdown. I see 10 comments there. Bitcoin, okay, I covered that this morning in the other video, Bitcoin backtesting the wedge. Let's take a look at it, see if it's still there. GBTC is Bitcoin Trust, 60-minute chart. And that's it so far, yeah, the back test. And we've already back tested. The problem with back testing is you can continue to back test, and you don't want to go underwater. So really a stop above today's highs, if you're in that one, would be prudent in my opinion. Because breakdown, sometimes you go and hit the first target, and sometimes you break down, have a little kickback rally to back test, that a virgin high is still in place, and everything else. So that's the update there. Okay, oil. I already covered that in today's video earlier. Yes, I did. I got this. That's that chart I got out to earlier on ZB. Gold and silver miners. Sure. Gold recently gold futures put in a divergent low on the 60-minute chart and broke out above what appears to be a bullish falling wedge today. So looking good for now. However, I don't have a good read on GDX. It's looking like a correction in crude. The correction in crude may be close to over, as per today's video. I covered that earlier. And if so, rising or high crude prices often put pressure on the miners, as energy is one of their biggest costs. Okay, think of it kind of like the airlines. Labor being the biggest cost to them, oil, fuel the second. Gold's not floating around and on top of the riverbeds in Sacramento anymore. You got to dig deeper and deeper in the ground to find it. So this isn't 1849 anymore, and it takes a lot of energy to move the earth to get down to that gold and get it out and market and all that stuff. So big expense for the miners. There's GDX. And remember, GC, gold futures. Remember, we shorted it here. It was a short. I gave you a few pullback targets, and we just hit this one the other day. But then we put in this 60-minute bullish falling wedge. So you had divergent high right there, correction, and now bullish falling wedge, breakout. As I stated, I'm kind of a spectator on this one right now, just kind of watching. I don't have a strong enough conviction to take a position. Okay, that was, go back there. Let's go back. That was that one right there. This one I think was just an administrative note, if I'm not mistaken. Yep, somebody locked out of their account. I took care of that. No problem. You're free to post it there. I don't check the comments. The support form goes to an email inbox that I monitor when I can. I'm a one-man show. I do this because this is my passion. Trading this site is more of a hobby. It's not my primary source of income. And the day it ever becomes a job is the day I need to quit and do something else. So my apologies if you ever send a thing on the contact form. If you have questions on even membership questions, just post them here on the comment section. I check that much more often. And so anyways, I took care of, if that was your post, I took care of it and sent a reply. You should have an email today. Everything's fixed. 8 comments here. Let's see what they are. Is there any possible action here? That was on the IWM thing that I posted earlier. Okay, so this is a good question. Here's my reply. Well, yes, sort of. Okay. So there are 2 active trades right now for the stock market related securities, mainly short QQQ and TLT. And that's as of this moment. Not to be confused, swing trend trade, TLT looks probably more upside. near term today was downside. And we hit our minimum target, so that you can book profits there if you're happy with a 1.5% pullback. If you trade ZB like I do, Treasury bond futures, I don't have to tell you how much that puts probably thousands of dollars in your pocket, just that 1.5% pullback. But again, futures are leveraged and it's not for everybody. But as far as IBM, that's more of a highlighting some notable developments that could be longer term bearish for IWM and the overall stock market. With the recent ongoing and implosion in many small cap stocks, something worth to continue monitoring at this time. I'm always going to get typos. I try to get this stuff out to you guys. I don't always proofread my stuff. Additionally, IWM was also highlighted as a potential short setup in this post on a solid break above that key 162 support zone. Again, this is IWM. That's the trading range. That is a great support level. A break of that, especially, or if the divergences get taken out, then IWM is probably going a lot lower. So hopefully that makes sense. So I covered that mostly as something to watch for the markets, and just looping back to that, because like I said, I'm seeing a lot of these aren't micro caps. Their micro caps are smaller than the small caps. There's even an ETF that tracks micro caps, but I'm not looking at those. Those are typically, I don't know if they've changed as time goes on, inflation goes up and the stock market goes higher. We never had a $1 trillion company until a few years ago. Apple was the first, and then it hit 3 trillion recently. But back in the old days, it used to be a micro cap, I believe, was anything under 50 million or 100 million, and then small caps 100 million to 500 million. It might have changed. Mid caps again, and then the big caps, the large caps are the billion plus companies now. But the point I was trying to make here is that the IWM, the Russell 2000, these are good sized companies, and many of those that I highlighted earlier in that post that are down anywhere. There's about 2 dozen. Earlier there were. Now there's probably more. 2 dozen that were down. Here, I'll just show you. 20 to 80%. IWM, go here. I'll just slide it over for you. TC 2000, just go to your watch list on the side. Well, I have it populate every time I key in a symbol on the chart. If it's an ETF, it's going to show me the components or a sector. And then I just sort here. That's by gainers and that's by losers. So you've got, 78. You probably can't see it on the video. That's almost 80%, 76%, 73, 60, 53, 46. These are all down, down to this point. They're all down, anywhere from 80 to 20% and growing. And there are almost 2,000 companies in the Russell 2000, showing me 1,968. But again, this isn't one day. This is a trend I'm seeing lately. And then knowing that small caps are much more dependent on, much more sensitive to interest rates because they're not as well established as large caps. I've used that example recently. Apple doesn't need to borrow money. They just borrow it because they could in recent years because the Fed made it so cheap to do so. And so, but a lot of these small caps are completely dependent on borrowing money to finance ongoing operations and or expansions. So when credit contracts, they're going to feel it the worst. So yeah, we could see, IWM has a potential fall a lot more. Now there's, positive divergence, or there was at the recent low. We had a little pop there. Again, the chart my point here wasn't to cover IWM in detail. I just kind of bigger picture wanted to paint that for you and say, hey, if things start to get ugly, especially if we see this large caps roll over, the Magnificent Seven, the S&P 500, and then IWM breaks this, there could be a lot more downside. Small caps tend to rise and fall more than large caps over time because they're smaller, faster growth rate companies. You get a company like Apple, it's kind of like Coca-Cola was, 30, 40 years ago. Companies hit that maturity point where they get so big and then they're mature companies and their growth rate isn't as high. They just turn into cash cows, generating a lot of revenue, but not a lot of growth at that point. So that's why they start to shift to paying more dividends and stuff like that. Okay, so I just wanted to clarify. I thought that was a good question. Yeah, I don't see, right now, despite those, some of those companies getting hammered in there. Like I said, IWM is just above support on the daily chart, big support, and it's coming off a divergent low on the 60 minutes. So I can't make a strong case to short it. You can have tactical short-term pullback trades. Let's see here. Oh, that's that. Somebody asked about Lily. Sure, I've been keeping my eye on Lily. Lily will trigger. Let's open the chart. It says it right here. Lily will trigger an objective short entry on a solid break or close below this uptrend line right there, while any marginal new high before then would only extend the existing negative divergences that have been building. So you can see we had at this high right here, that was a divergent high. I always say divergence is not a sell signal. It's merely an indication that the upside momentum is waning. You can see there, we've been building divergence for a while. And should this stock have another thrust up, Mounjaro just got its, finally, we knew it would happen, got their approval for weight loss. That was a diabetes drug. Remember, Novo Nordisk was first to market with Ozempic and the other one, I should know, my wife works with the company, but and then this same thing, the GLP-1 drugs, one's making everybody lose all the weight, really changing everything. Biggest blockbuster drugs probably be in history. Anyway, but again, here with Lilly, I'm only going by the charts. I don't care. I know how much of that's been priced into this tremendous move the stock has had. And, they're down today. So here's an example of buy the rumor, sell the news, right? It was today's headline, I think, that came out today that they got the approval on Mounjaro for weight loss. The indication, that is, again, was an existing drug, but only indicated to treat diabetes, and now weight loss, which again, doctors have been prescribing it off label all along, just like they were with Ozempic before. I'm drawing a blank on the other one. It's the same drug, just in a higher dose, same exact molecule for Novo. Anyways, there it is. So we did actually have also a divergent high there. And I don't want to spend too much time. I just want to mention I shared that setup there, and I have a price alert, and there's the targets. Big old fat gap. Gaps are like magnets. The buyers will probably step in and buy the top of the gap. If they don't, they'll most likely buy the bottom of the gap, especially if we went straight through. That would be a great point to cover. But again, it's too far ahead of ourselves. We haven't even broken down yet. No sell signal yet. Okay, last but not least, in the most recent post before this video, this is right here. I'm sorry, I was trying to show you the post. I'm all zoomed in here. VIX showing some life, but I guess the 2124 bottom of the buy zone is now resistance. Great question, but not necessarily the case. Let me just read my answer, because this, I believe, is important. Okay, so I went on to say, great point on the bottom of the support zone now being resistance. But in this particular instance, not necessarily. If it were a stock or a non-leveraged index or sector ETF, then yes, support once broken becomes resistance. I'm digressing here, or adding to that. However, although VXX is not a 2 or 3 time leverage ETN, so it does not employ leverage, it does track what is probably the single worst index for decay of any of them out there, and that's the VIX. The cost to roll the futures, remember, this is what this ETN is. Nobody can buy the VIX, the spot VIX, the one they talk about on CNBC. That's the spot VIX index. You can only buy derivatives that attempt to track it, and those are the VIX futures, the options on those VIX futures, or ETNs that then buy the VIX futures and roll those. VXX is the short-term futures it tracks. And so there's a lot of cost, all this decay, I don't know, the things that over time will cause VIX to gradually and consistently lose money or fall more than the VIX. If you pull a chart on the VIX, go back, it's where it was 10, 23. The VIX is range bound, it has a floor, it never goes down. Theoretically, I guess it could go to 0, but not below that. But here, I'll just show you. Sometimes I sit here and I start to explain these things when it's just as quick to show you. This is the VIX. Over time, see, it's kind of range bound here. It's not a set range, but it's been as low as about, around $9 on a few rare examples, and it goes up and it goes down, but it never goes anywhere. It's almost like an oscillator, like the RSI, right, on your securities. But then when you use an ETF that tracks it, you're going to lose money over time. So they're not buy and hold. They're hit and run investments, hit and run vehicles. And you need to know that. And that's very important. In fact, in my former life, I was a stockbroker, i.e. financial advisor. And we had, this is a big one we had to employ. It's FINRA Rule 209. That's the Know Your Customer rule. Well, you probably heard me say this in the past if you follow me a while. I have my own rule. I no longer abide by this. I don't give individual specific investment advice. I just share what I'm doing, what my thoughts are, provide analysis. You guys decide what to pull the trigger on and what not to. But the Know Your Customer rule, as the name implies, you cannot, a broker, if somebody came in, you had to know their financial situation. You can't just come in and say, give me a good idea on a stock and buy Apple. It's a great one. You're always going to make money on it. No, you had to know their whole situation, their objectives, their financial situation. So where am I going? I have a rule. It's called Know Your Security rule. Whatever you're going to trade, if you're going to trade the VIX, I can't sit here and every time I post a trade idea and give every little nuance of that individual security. If you're going to trade options on VIX futures, you better know they have a different expiration date than stock options. They trade differently. If you're going to trade futures, you need to know about roll dates and other things like that. Their leverage factor, trading hours, they're all quirky. Wheat futures don't trade the same hours that stock futures trade. Completely different hours, quirky hours. So again, know your security rules, whatever it is. If you have questions, ask me. That's what I'm here for. But that's one thing that's very important to know, that when you're trading the VIX via any of these derivatives, such as VIX futures or ETNs, you're not buy and hold vehicles. It's hit and run. It's basically you're short selling if you're going long the VIX, because I always talk about this, and most of the time, 90+% of the time, stocks go up, and that's why short sellers we're a rare breed. It's a lot easier to just be bullish all the time and buy long, because even if you're wrong and you buy at the worst time, like right here, let's say, or right here, and you hold long enough, the market's going to bail you out, at least in a secular bull market, which we've been in for decades, and that may no longer be the case. So that whole buy and hold or the market will always bail you out thing may not always be there for you. But in shorting, you can make a tremendous amount of money in short order. Stocks typically fall, and the stock market typically falls in the matter of days or weeks what it took months or even years to make in gains leading up to that point. But you have to be Johnny on the spot. You cannot stay too late to the party. If you do, you're going to see your gains evaporate in the blink of an eye, because once big corrections are over, the snapback is very strong and swift, and it just doesn't let you out. Okay, so that's that. And now, so what I said in that reply there, let me go back to that, go back here. Oops. Okay, I'm trying to get back to that post. So I'd already showed you the long-term comparison. See, over time, the VIX goes sideways in a big fat range, which is extremely big range in percentage terms, hundreds of percent from top to bottom. But you just got to get the timing right. And then I said, look, best to align entries and exits on any VIX trade, VIX tracking ETN, with number one, the stock market, particularly the S&P 500, because that's what the VIX tracks. Number two, the particular VIX futures that particular VIX ETN is tracking. So in the case of VXX, that's the front month and next month futures. So it's rolling near-term futures. They have another ETN out there that tracks only the midterm VIX futures. I forget, that might be VXN, I believe. Who knows? There's a bunch of them out there. So you need to know that, okay? And then you want to watch those futures, even if you're trading the ETF or ETN. And then finally, you can also chart the spot VIX as well. There's some value in that. But first and foremost is the stock market. And then I went on to say, and here's the takeaway. The easiest way to trade the VIX, if that's what you decide to do, knowing it's volatile, is simply go long when you have a high degree of confidence for a pullback or a short trade in the stock market. And then you can short the VIX via the futures, puts, calls, whatever you want to do if you want. That's too much for my blood. I've dabbled in them. That's like, trading the VIX itself is like the stock market on steroids. Then you trade the futures, you're leveraged up, but then you trade the options on the futures. That's just too much leverage, too much juice, too much volatility. If you're good at using complex option strategies to mitigate your risk, by all means, but don't go. I wouldn't go raw dog on the VIX futures. Been there and done that. You can put a lot of money in your pocket very fast and take a lot of money out. But anyways, so that's it. Basically, you trade the VIX, but the keywords I have here is go long the VIX when you have a high degree of confidence for a pullback short trade in the stock market, and short it when you have a high degree of confidence for a rally in the stock market. In other words, day in, day out, I'm posting trade ideas. I'm giving you analysis on the VIX. I'm sorry, on the S&P and NASDAQ 100 almost on a daily basis, if not multiple times a day. And so I'm always going to give you, here's what I think it's going to do. But I try to convey my convictions. There are times I have a much higher degree of confidence where the stock market's going, and a lower degree of confidence. So low degree of confidence, stay away from the VIX, because when you're in it, it's just going to decay if you get in a little early. So when you have that highest degree of confidence that the market's going to drop or rally, that's when you might want to, you can use VIX to kind of juice up your gains, because again, it's going to go up or down a lot more in percentage terms than either the S&P 500 or the NASDAQ 100. And then finally, just like when you're short selling or are short selling, don't stay too late to the party on either trade on the VIX, whether you're going long or short. Book profits when you think the move might be over or close to over. Okay, it's that whole don't get greedy thing. Bulls make money, bears make money, pigs get slaughtered. Pigs also get slaughtered by staying too late to the party on the VIX. Okay, I'm going to wrap it up here. Markets close in 10 minutes. This has been Randy Finney with Right Side of the Chart. Have a great day.